A loan is a financial arrangement where one party, typically a lender, provides funds to another party, known as the borrower, with the expectation that the borrowed amount will be repaid, usually with interest, over a specified period. Loans are a common financial tool used by individuals, businesses, and governments to access capital for various purposes. Here are key elements of a loan. Key components of a loan. Principal. 1. The principal is the initial amount of money borrowed. 1. It represents the original loan amount that the borrower is expected to repay. Interest. Interest is the cost of borrowing money. 1. It is calculated as a percentage of the principal and represents the compensation the lender receives for providing the loan. 1. Interest rates can be fixed or variable. Term. 1. The term or loan duration is the period over which the borrower agrees to repay the loan. 1. Loans can have short-term durations, e.g. a few months, or long-term durations, e.g. 30 years for a mortgage. Repayment schedule. 1. The repayment schedule outlines the timing and amounts of the loan payments. 1. Payments may be made monthly, quarterly, or according to another agreed-upon schedule. Collateral. 1. Some loans are secured by collateral, which is an asset pledged by the borrower to the lender to secure the loan. 1. If the borrower fails to repay, the lender may seize the collateral to recover the outstanding amount. Guarantor or cosigner. 1. In some cases, a third party may act as a guarantor or cosigner for the loan. 1. This person assumes responsibility for the loan if the borrower is unable to repay. Types of loans. Personal loans. 1. Unsecured loans for personal use, such as medical expenses, debt consolidation, or home improvement. Auto loans. 1. Loans specifically for purchasing a vehicle, with the vehicle itself serving as collateral. Mortgages. 1. Long-term loans used to finance the purchase of real estate, with the property serving as collateral. Student loans. 1. Loans designed to finance education expenses with deferred repayment options for students. Business loans. 1. Loans provided to businesses for various purposes, such as expansion, working capital, or equipment purchases. Payday loans. 1. Short-term, high-interest loans typically used by individuals to cover immediate expenses until their next payday. Credit cards. 1. Credit cards represent a form of revolving credit where users can borrow money up to a certain limit and repay it over time. Loan process. Application. 1. The borrower submits a loan application to the lender, providing information about their financial situation, purpose of the loan, and other relevant details. Approval. 1. The lender reviews the application, assessing the borrower's creditworthiness, financial stability, and ability to repay the loan. Terms and conditions. 1. If approved, the lender provides the borrower with the terms and conditions of the loan, including interest rates, repayment schedule, and any applicable fees. Disbursement. 1. Once the borrower agrees to the terms, the lender disburses the loan amount, either as a lump sum or in installments, depending on the type of loan. Repayment. 1. The borrower makes regular payments according to the agreed-upon schedule until the loan is fully repaid. Closure. 1. After the final payment, the loan is considered closed and the borrower has fulfilled their obligation. Loans are a fundamental aspect of the financial system, enabling individuals and businesses to access capital for various purposes. However, it's important for borrowers to carefully consider the terms, interest rates, and repayment obligations before entering into any loan agreement.